The financial world just witnessed a milestone that felt like a distant dream only years ago. Gold has surged to an unprecedented $4,875, a historic peak that redefines our understanding of store of value. In a staggering display of dominance, gold has added a colossal $19 trillion to its market capitalization in just the last 24 months. To put that into perspective, that growth alone is 10 times the total market cap of Bitcoin. While the world has been fixated on the digital revolution, the old guard of finance has quietly staged a monumental rally, proving that in times of global uncertainty, the world still bows to the yellow metal. However, this record-breaking surge carries a whisper of a massive shift on the horizon. Markets move in cycles, and as gold nears its local ceiling, seasoned investors are asking the trillion-dollar question: where will that ocean of liquidity go next? Historically, when gold reaches a point of exhaustion, a portion of that capital seeks higher velocity alternatives. If even a fraction of gold's $19 trillion expansion flows into the leaner, more supply-constrained Bitcoin market, we could be standing on the precipice of a parabolic rally unlike anything seen before. We have seen this script play out in smaller cycles, but with gold's current scale, the potential spillover could ignite a digital firestorm. Why this matters for your strategy: the size mismatch. Gold's recent growth is 10 times larger than Bitcoin's entire existence. This means the overflow from gold doesn't just move the needle for Bitcoin, it could break it. The timing. Tops are hard to predict, but the divergence between physical and digital gold is narrowing. The opportunity. While you enjoy the gold harvest, keeping a cool-down period after selling, as per your 7-day rule, might allow you to spot the exact moment this capital starts migrating. When engaging in the trade of precious metals such as gold, silver, or copper, success is predicated on a well-defined exit strategy. Before capital is deployed, one must establish a clear investment horizon, distinguishing between short-term positions of 3 months and long-term holdings of 3 years. While market surveillance is necessary, it is imperative to remain detached from short-term volatility to avoid emotional decision-making. Furthermore, once a profit has been realized and a position closed, one should practice psychological discipline by avoiding hindsight bias. Dwelling on potential gains missed by not selling later only diminishes the value of the actual success achieved. Following a liquidation, a mandatory cooling-off period of at least 1 week is recommended before reinvesting, ensuring that subsequent moves are driven by logic rather than impulse. Consider investment as a biological growth process. Frequent interference with the roots of your portfolio prevents it from maturing. A committed outlook of 3 to 5 years is essential for these assets to deliver substantial returns. Ultimately, integrating ethical partnership and spiritual gratitude into your financial journey provides the most sustainable path to prosperity. By celebrating the success of peers rather than succumbing to professional envy, you foster an environment conducive to your own long-term growth.